Now, welcome out here, friends. And, back to the book club is what we're going to be doing here today. Trading Justice number 215, I believe, is our episode count. It's kind of hard to keep count, Matt, when we have as many as we've had. I really thoroughly enjoy a process that we've built here for our podcast and our listeners out there. Today, guys, we're going to be talking with Roel Sarmago, and we have opened up a webinar room. We're having a live podcast. So if you're listening back to this, in your car or on your phone or when you're traveling, we will be doing these live events every now and then. If you want to keep apprised of that, make sure you follow us on social media, Facebook, Twitter, that kind of thing. And also get in the clubhouse at Tackle Trading, and we keep you guys posted. Undiscovered Riches is the book. It's the book of the month, and I guess it's been the book of the last 2 months because we've been waiting to plan this thing out. Roel, I just want to say, hello to you and have you come in and say hi to the team first off.
Hi, Tim. Thanks for having me back again. Hello, everyone in Tackle Trading Land.
Yeah, and then Matt, Live Book Club podcast. Always a lot of fun here. Let's go through the market skyline, Matt, but I want you to also just kind of say hi to everybody out there.
What's up, everybody? It's good to be with you guys here. Back with the book of the month. Tim, we started that book of the month club about a year ago because we just felt like it was important for people to start reading more. And I think get off Facebook a little more, get off Twitter a little more, start get a good old-fashioned book out there. There are some absolutely amazing books that we can learn from, and Undiscovered Riches by one of our team members, Roel, is one of those books. Because I think there's a lot of things that we grow up thinking that aren't true. There's a lot of things that we are told that just simply aren't true, and I think it's important for people to learn from the experiences of other people because what I was told growing up versus what Roel was told growing up, there's going to be some truth in all of that. And so I thought it was an amazing book, and I'm looking forward to the next book of the month, which we'll announce at the end of the pod here.
There's no question about it, Matt. And I can tell you this, personal testimony here, and I've read a lot more in the last year once we started our book club. And I think that it's like anything in life. You build a habit, you build a routine, you build a process, and you just start doing it more. And frankly, all the great entrepreneurs, they read regularly. It's not always the same kind of content. I've read all kinds of things. I've thoroughly enjoyed what we've done here, and I want to get into our discussion. We're going to talk about the book here in just a minute, but what I first want to do is actually kind of, have a podcast where we go through the market as well. Let's start with the overall market. Here we are moving through earnings season, and we're getting into the back half of the second quarter now, actually middle of the second quarter, I should say. But when it comes to earnings, Matt, it's always front loaded in that first month. Now that we're getting into May, that old adage, we're going to hear it a million times. We might as well be the first one to say it. Sell in May and go away. Do you think it's got any steam this year? What do you see in the overall stock market right now?
Well, the sell in May and go away is a cliche. It's been a cliche for a very, very long time, and the reason it is a cliche is because it's there's some truth to it. If I'm looking at the market here and I go out, the last 10 years, for example, and I just kind of look at those May type periods. You had May right here. You got a little bit of a decrease in price. Wasn't really that bad, about 2% down. Nothing to really be concerned about. 2015, let's go to May here. Saw a little bit of depressed in price, but price certainly didn't appreciate. Looking back to October here, in 2014, the price actually went up. So we're 2 out of 3. If we look at here in 13, price actually went up. So you're 2 out of 4. Here, price went down 3 out of 5. Here in May, right there, price went down 4 out of 6. Going all the way back to 2010, 5 out of 7. So if you look out the last 7 years, 5 of those years, price went down. But you also have to look at some of those economic environments at that time too, Tim, because in 2010, 2011, when the summer happened, you also had some news come out. European debt crisis came out then. 2013, the year that it kind of went up in price, you had, quantitative easing happen, and quantitative easing was pumping $85 billion a month into the marketplace. So, some of it is just, there is some truth to the sell in May and go away based on historical data, but I also think you got to consider the economic times. And, right now, looking from an economic perspective as well as from a technical perspective, the market's sitting up at an all-time high right now. It's kind of hovering over that all-time high. Looking at that, I might be a little concerned about it, especially if we start to see some economic news. But, I think the number one thing that might drive it this week is the unemployment report coming out. But outside of that, there is some truth to the historical jargon of sell in May and go away. But you always got to follow the price, and the price right now is still bullish.
I love having a coach like Roel here as well, so we can get his take on the whole thing. Roel, as you look at stock prices, and one thing we always do on these podcasts, and you've listened to them for a long time, is we look at the overall market kind of first. So let me get your take on stocks right now, Roel, equity prices. As an international investor, I know that you're heavily invested looking at the U.S. markets as well. What do you see in the chart, the seasonality? What's your take on it?
Well, I am begrudgingly cautiously bullish. It's been the same story that we've been all talking about for the last few years, and I personally, the newbie side of me is still made some poor decisions with betting contrarian. But you know what? I'm just sticking with what we've all been talking about week to week in the coaches show, and just say, you know what? The trend is your friend, and I feel personally there's no real technical bias behind it, on my opinion. I think it's oversold, but or sorry, overpriced. But we got to stick to what the chart and the trend show us, and still trade with that.
Yeah, I agree with that.
Sam,
And I even like the word there, Matt, begrudgingly
I was just
bullish.
going to say the same thing. I was just going to say the same thing. Is I'm a begrudgingly bullish, right? We've heard it like I'm cautiously bullish. I'm passively bullish. There's been a lot of ways where people have described being a positive one on the market trend, but getting punched in the face, kicked down bullish. I think that's that's a little different way to describe being a bull. But I certainly understand why Roel would say that, because we're all looking at the market the last year, and we're all like, all right, when's this sucker gonna hit? When's this thing gonna go down? What's that black swan event that has to happen for this market to go down? Is it really a threat of a nuclear war? Is that the only thing left that might drive this market down? But we shouldn't get into the point of overthinking it. We shouldn't get into the point, well, there's so much negative economic news, and I'm not saying there is, I'm just saying we should never get into the point of there's so much negative economic or negative political or negative this news that we don't understand why the market isn't going down, because the market's much bigger than we are. So, the begrudgingly or the passive or the cautiously bullish, I think that's a great way to describe it. And we're going to be bullish until we're not.
Yeah, there's no question
Hmm.
about it. And one of the things we all have to do is break down the old thinking. It's kind of a big part and kind of tied into our conversation for later of undiscovered riches, breaking down old thinking. And the old thinking is you just kind of leave your money in the market, you ignore it. Well, I mean, we have to pay attention. We have to be bullish if it's bullish. When it turns bearish, we're going to trade with it. One of the things we definitely promote, throughout all of our education, anytime we can talk to another trader, is just be open-minded to whatever's in front of you. There's an old saying, Roel, we trade what we see, and I agree. It is still bullish until it's not. And that's why we're going to keep coming back and looking at it every day and every week as part of our market posture. Let's talk about earnings reports a little
Hmm.
bit. Matt, I see that you're bringing up, a scan for looking for earnings dates. The past week, the next week, there's still a lot of big major companies on the docket coming out here, Matt. In
Well, you're
fact,
seeing the top one
yeah, Apple Computer.
right there.
Yeah.
I mean, every company reports earnings. There's no doubt about that. Apple is reporting earnings, I believe, is it tomorrow? I want to say tomorrow. Is today the first?
It is the
Yes.
first.
Yes.
By the
So
by the way,
tomorrow,
how many times are you going to hear "May the Fourth be with you" in 3 days? What's your over under?
over under,
Yeah.
like on Twitter, Facebook, Instagram, Oh man, at least 100.
It's
At least 100.
it's
It
come on.
literally is going to be more annoying than pictures of cats on Facebook. It's gonna be but you know what? As a Star Wars geek, I'm okay with it, right? I'm okay with it. It's that one date where it's like, okay, let the geek out a little bit. So let's all geek out. I'm fine with that. But looking at Apple here, I mean, you talk about a company that's literally on fire right now, up 2.5% today at an all-time high. Tim, we have earnings tomorrow. Okay, we have yes, unfortunately, we have earnings on Apple tomorrow. But I read a report from some analyst, and I want to get your take on this. That Apple is going to be the first $1 trillion market cap company, right? And I believe it will as well. But
Hmm.
they were saying this year Apple is going to be the first $1 trillion market cap company. What do you guys think? Yes or no? What do you think?
Why not? I can't really come up with a reason why it couldn't hit that valuation, Matt. Market stays bullish, market stays begrudgingly bullish, like Roel was talking about. Apple's been going up. In fact, I'm writing a newsletter for Trading Justice right now, Matt, and I'll tell you one of the titles I was considering is the next tech bubble. Technology is where everybody's focused on right now. If you think about Amazon, Amazon blew out earnings, went up. Netflix had a good quarter. Microsoft missed, but they're still flat. You look at tech company after tech company after tech company. Google exploded, to the upside. These big names, they just keep going up. They go up, 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 up. I don't know why Apple would not continue to lead that charge. What is the price per share on Apple right now? What is that?
Oh, Apple is about
146?
147, $147 close, 146.99 hit the high of today. If he has a great earnings tomorrow, you see a lot of let's say it's up 5% tomorrow because Apple doesn't really drive further than 5% on earnings most of the time. But let's say they have a repeat of what we saw last time on earnings, and you saw it drive from 121 up to 128, which is about 5% on that. But then in the next month, it went from 127 all the way to 140. So you're talking 120, 140, which is about 18% in about a month and a half, right? So let's
Hmm.
say they do something similar. Apple would need to go up the rest of the year about 22%. From this point on, Apple would have to go up about 22% for it to reach that $1 trillion mark. And
So they can do
that
that.
means
So give me
from
the number then. So
you're
22%,
talking a you're talking a well, you're also talking about 65% on the year. And
right?
guys, this isn't a illiquid, cheap stock that jumps from 10 to 20. This is
Right.
the biggest of the biggest, moving 65% a year. I don't know.
Well,
Has
I
the
will
market
say
lost its
this.
mind so much?
Yes, it has.
Wow.
It's completely lost its mind. I mean, every story is right now being driven through a frenzy of how technology is this, technology is that. Roel, I want to let you come in and give your take, though. But that, to me, Matt, the short answer is yes, it can. I don't see why not. Roel, what do you think? $1 trillion Apple. That's pretty crazy to even think about.
It is pretty crazy, but I mean, what I think we all, especially I'll speak for like kind of like the beginner to intermediate level traders, is we got to struggle with is we got to look at it objectively, and you look at it, it's still in that bullish uptrend. So stranger things have happened, and that's why we love technical analysis. It tries to take out the emotion as much as possible.
Hmm.
So is it in the right trajectory? Yes, but do I personally think it will? Again, I'm hoping the market digests and comes down, but you got to still trade what you see. So
Sure.
I
Yeah,
I
I'll
I
tell you.
I'm gonna say
Go ahead,
no.
Matt.
I'm not gonna be on the fence like you and Roel. I'm putting it out there. I'm saying no. Roel's like, yeah,
emotionally, I
can it be?
agree.
Yeah, Tim's like, yeah, yes, it can, right? You're leaving it out there. No, 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 no. Apple's not going up 65% a year. Can it? Yes, that's my hedge. But no, no, it's not gonna. That is wow.
Look at the
The
trend.
the
I
amount
mean,
of things
honestly,
that would
look at
have
the
to
trend.
happen.
That stock has
It's
gone
it's vertical.
nuts, right?
It, Yeah, it's vertical. There's no doubt about it. It is vertical. Okay, nobody can say anything outside that. Yes, it is vertical. It's doing great things. It's doing amazing. There's no doubt about any of that. But when it comes to, again, right, when it comes to what we're seeing right here with Apple, what we're seeing with Amazon, what we're seeing with Google. I mean, look at Amazon. Look at this. Look at this. Look at this candle here, guys. Tell me the last time you saw something like this.
Okay. So I used to play this game with my students in my trading lab, and this is always a question I would ask them, Matt. What's more likely for it to hit a certain number, up or down? It's a way for you to kind of project out technical analysis. So we're at 146 right now. I want you to go back to the chart on Apple. We've got a live, podcast here, so we've got a room of students and traders, and we can get their take on it. Put it on a 3-year weekly chart. And I'm just going to ask everybody because at $200, that's another 50 points, Matt. That's over the $1 trillion market cap. Is it more likely that Apple hits $200 or $100 next? So is it going to come back to 100 and lose 50 bucks or go up to 200 and gain 54 bucks? All right.
Listen. You just got a new segment for the
I
pod.
like it.
What's more
What's
likely,
more likely?
right? What's more likely? Okay, so what's more likely? Apple at 200 or Apple at 100? That's the what's more likely. Okay, so if you think Apple at 200 is more likely, type yes into chat. And everybody's got to make their vote.
So Adi
So
says 200.
Adi has 200.
A lot of yeses.
Esteban,
Yeah, a lot of
Chris,
yeses coming in here.
a lot of yeses coming in. I think most people would say that. Okay. Greg, what did tulips hit like 300,000?
I love the tulips
Tulips,
reference, by the way.
the
That's pretty
the
cool.
greatest hyperinflated, lost their mind at some point, guys. And maybe some of you didn't know this, but at some point, tulips were the most valuable thing in the world, like in the world. I'm gonna say no. I'm gonna say it's not. I'm gonna say the hundred's more likely. If you gave me 170 versus say 127, I'd probably say
Well,
170.
170, Matt, it's
But
$24 up. $24 up is another, what is that, 15%? Uh,
15%.
yeah, I mean, you're close to, honestly, you're close to that 900 billion market cap. Now we're just arguing over billions here, Roel. It's unbelievable.
Hey guys, soon enough, 5, 6, 7 years from now, it's like in the 80s we argued over millions.
Right.
In the 2000s, 2010s we argued over billions. At some point in our lifetimes, guys, and I want you to think about this as an investor, we're going to be arguing over
Yeah,
trillions
it's true.
at some point.
Well, we already are with the
And
Fed.
and
Yeah.
and also, but you know what's cool? You know what's cool is that we can all participate in making that money, right? We can all participate that in making that money. So I would say, it's obviously has lost its mind. I mean, Apple, just coming here to Apple. Typically before earnings, guys, you don't see this. You don't see a breakout followed by a continuation up 2.2%. People usually wait
hmm
to see that.
hmm
Something's happening
Yeah.
here. Something's happening here, and I don't know exactly what it is, but typically you see this price action. People kind of just, let me just wait, let me just see. Man, you can't argue with it. It's a breakout. It's bullish. People are loving it, but I'm still going to say, I mean, what's more likely? I would say Apple at 100, but that's more because I think it's not going to get to 200 in 2017. I think 2018 is going to be a fairly depending on the economic conditions,
Roel's got a vote.
it could be
Roel, 200 or
very
100?
raising interest
You know
rates.
what?
Well,
I'm gonna say 100. I say 100. Like that's why I said it from the beginning. Emotionally, I think it feels like irrational exuberance again, and it's just like it doesn't feel like there's any sense to it being where it's going. But if I were
One of
to
the
trade Apple, which I don't personally, because I want to see it, I want to see it come down. I know I'm going to short it, but if I were, I'd probably do like a probably a bull put spread at some point if it
yeah.
pulls back. If you actually look at the monthly chart, it looks like it's losing momentum. It might pull
yeah,
back. Then I might get into it at around 130,
I like this game
135.
though.
oh,
We're gonna keep adding
I'm a
this.
big buyer at 130. Oh yeah, I'm a big buyer at 130. There's no doubt about that. By the way, I was adding up Tesla, Apple, both those stocks are on the latest edition of the 25 guys, and Netflix on the 25 as well. The 25, the Tackle 25 released last Friday, okay, or whenever it was a week ago, like yeah, last Friday.
Tuesday.
The Tackle 25 is off to a really good start, guys. It's up 17% today. 17% in one day. Think about
Right.
that. Now that obviously cannot be sustained, but what a list.
We're talking with Roel Sarmago, who is the author of Undiscovered Riches, How to Find Your Hidden Wealth. It's the Book of the Month Club. We're having a live podcast here, and those of you who are here live, we appreciate it. And those of you listening back on the replay, try to catch the next one. We're going to be announcing that. I think it's going to be the first week of June. We'll talk about that at the end of the podcast. Matt, before we move past the market skyline, I do want to get Roel's take on the real estate market. If you could bring up the real estate index at some point. IYR is an ETF where we can track it. Now, you and I, Matt, we know Roel
Yep.
very well. He's been a team member, a fellow trader, coach. We've worked with Roel. We've, seen him impact people's lives. And one thing that Roel does is real estate investing internationally and in Canada and the US, I believe, Roel, correct? As well as stock
Soon
investing.
to be in the US, yeah.
Yeah. Roel, what's your take on the real estate market right now? And what's your overall opinion of real estate? I've made the statement that real estate has a very high valuation. When you measure the PE ratio of real estate, it's one of the highest sector by sector. What's your take on it?
Well, we're coming back the way I see it. Well, not even the way I see it, but we're coming back in many areas to pre-crash levels. So, in terms of rebound or what do you call it? Getting back to where it was prior to the crash, we're very close there. And so, for someone to get into the real estate market and start investing now, it's very much localized. So, but in terms of general, in terms of like national average for U.S. national average, um, we still got to follow the same principles that is taught on the real estate side for legacy, is to make sure that you're able to make money in the buy
Mm,
and buying at a discount, right? Because we don't know if the market's going to turn. If you look at the longer term of IYR, it looks like it is slowing momentum. It's kind of a curve that's kind of flattening out a little bit. But who knows? It could just all of a sudden hockey stick upwards again, and it could go sideways, or it could drop. But if anyone is looking to get into an investment type property, to always hedge your investment is always try to get it below market value. That's one of the nice things about individual um, ownership or investment into individual pieces of property is you can negotiate a discount.
And Matt, you're looking up some data on real estate, and I believe this is going to be
Yeah.
measuring U.S. market data on new home sales and existing home sales. And what we're seeing
Yep.
is that we've been in a stronger trend. Stock prices, real estate prices, everything's at a high point right now. There's no question about it. It looks like the data dipped all the way down in 9 and 10, and then it started to trend back up. Matt, I know that you travel the country, spend a lot of time with new investors, many of whom are also real estate investors. What's your opinion on real estate right now?
Um, Real estate, I mean, when I'm looking at things and I'm gonna look at the market and we're gonna put this on a monthly chart so people can kind of see the visual here. So if I look out to a month and I go 15 years, right? This is the stock market, okay? That was the top of 2008 was right around 1550 in the S&P 500. It dipped all the way down lost about 57% value, and then it recovered. It's currently at 2,400. So you're clear about 66% higher than the previous high in the stock market. When you look at real estate, IYR, okay, the high was right here, and you have not even recovered price in real estate
Mm.
yet. You have not even recovered that, and the reason is because the bubble of 2002 to 2007 was subprime. It was real estate driven. So it's gonna get hit harder as you see it. It went from 95 all the way down to 21. It got absolutely smoked, and then it's going to take a very, very long time to recover in that environment, right? And you could look at the same thing with, say, the Nasdaq, right? The Nasdaq in 2000, it took a good 15 years before it recovered because that's where the bubble was. Wherever the bubble is, it's going to get hit the hardest, number one, and it's going to take the longest to recover, number two. And you're seeing it in real estate right now, and you're seeing it with the Nasdaq in 2000. Okay, so if you look at it from now a data perspective, here's what you're looking at: new home sales. New home sales hit the very pinnacle of new home sales. What as measured in millions was 1.5 million, and that comes into '06. Obviously, you started seeing this decline in '07. And if you start seeing a decline in real estate now, you should see that as a leading indicator for a decline in terms of the stock market as well. But if you just look at kind of the recovery, and the recovery kind of bottomed out in real estate in 2011, where it bottomed out in stock in 2009. So you obviously are on an upward trajectory here. But I'm starting to see some data right here that's giving me a little bit of cautious. That's giving me a little bit of caution to where we're starting to kind of smooth out. We're not really expanding that much. And you're really seeing that here on IYR right here from the visual on the chart. You're seeing a little bit of a double top. If we come back down to the daily chart here, you're seeing a little double top. You're seeing a bullish retracement come. That's a nice little Harami candlestick pattern. But I'm seeing some reasons to be cautious. And Roel, you're absolutely right. You're absolutely right. That real estate is very local driven. There's no doubt about that. You know, Salt Lake City, it is still a very hot market in Salt Lake City. They can't put up houses enough. It's hard to sell an existing home in Salt Lake because they're just tearing things down and rebuilding. Salt Lake's a very, very hot market. But when you look at the national numbers, I'm seeing some reason to be cautious there. So number one, it's going to take longer to recover to the highs of '06. And we might be talking 7, 8, 9, 10 years more for real estate to recover where it did. In terms of new home sales, existing home sales, building permits, the price action in the ETFs that track real estate. Markets are going to be a little cautious. But if you're looking at these numbers, Roel, I'm going to give you a would you rather after what you saw here. Because Roel, you're a real estate investor. You're an international real estate investor. You're now a stock investor as well. In If you had to pick one, okay, based on what you just saw here, if you have to pick one, and I'm going to put you on the spot. I think everybody knows what Tim and I would select, but you've done them both for a very long time. Which one do you think is going to be the easier
Would
market
you
to cash
rather?
flow in over the course of the next 2-3 years? Yeah, would you rather solely focus on real estate, Ryan,
What am I?
given
I'm
what
getting a bit
that
of a
is?
delay on my end. What are the two choices again, Matt?
Okay, the two choices are: would you rather, given the data that you've just seen, would you rather, if you could only pick one, invest in real estate right now or invest in the financial markets right now?
Investing in real estate or in the financial markets right now? Hmm. Well, with uh, the fact that where we're at on both sides, and the fact that I have been trained by the Justice Brothers on how to be able to actually cash flow the markets as they go down, I would say the financial markets because you can't really. It's not the same way that if real estate markets go down, you can't derive the same kind of profits as real estate markets digest. So
And
to
I
put
would
me on
agree
the
with
spot, I
that.
have to say that one or the other.
Yeah, and obviously you don't have to pick one or the other. We love them both. We just wanted to do the would you rather because we know you love them both. But you know they're both amazing markets. There's no doubt about that, guys. You can cash flow, you can find great deals in a lot. But when I look at the numbers, Tim, and again I'm just a numbers guy. I'm a research guy. When I look at the numbers, I see a real estate market that, from a national perspective, is showing some signs of caution.
Well, and I think part of the perception that comes from this, Matt, and I talk to a lot of new investors. First of all, I'm going to encourage anybody to go out there and be an entrepreneur. Invest in commodities,
Oh yeah.
invest in metals, invest in real estate, invest in everything. Be an I in the I quadrant. Many times people start with real estate, in my opinion, because they can physically and tangibly touch it. And so it's easier for us to conceptualize it. There's this old myth, going back to the seven myths, that Roel talks about in the book, that, if you buy a home, you've got equity in the home, you can build your net worth through the home equity, right? That's Roel's seventh myth that he goes out and attacks. See, if investing in real estate means that you're just going to buy something and hold it, I don't think anybody would say that's the best plan. But I do think that if you're going to hustle, you can make money doing anything if you're hustling. If you know how to
Yeah.
push,
Well,
your
yeah, if you're
strategy or
willing to put the
whatever it
work in.
is. Yep.
Yeah, if you know how to put the work in, if you know how to and I love that word hustle. Somebody came up to me. I was in Brooklyn this past week, and somebody comes up to me and they're like, you know what, do you think I could be successful at this? And we were talking about stock trading and cash flow and whatnot. I said, well, I got a couple questions for you. Number one, are you going to follow directives from your mentors? He said, yes. I said, good, you'll be great at it. He said, number two, I said, number two, are you willing to put some time in? Are you willing to put 30 to 60 minutes a day into this new business? And they said, yes. I said, you'll be great at it. And I looked at him, I said, you got some hustle in you?
Hmm.
And he looks at me and he's like, what do you mean by that? I said, well, we got to work on that one. Because if you don't know if you got some hustle in you, we got to work on that one,
Yeah.
right? But no, I think if you got some hustle, you can be good at anything. No doubt about that.
I definitely
Now, if I
believe
can jump,
that
if I,
Roel has hustle, and I'll let you jump in here, Roel, and kind of talk about that because Roel, as an author, I can't even imagine. I've been trying to write a book for a long time. I can't get it over the finish line. You know how much work it took to get your book out there. But then also you travel, you invest, you're raising kids, you're a speaker, you're a trader, you're a real estate investor. Roel, what are your thoughts on hustle and kind of just this part of the conversation?
yeah, thanks, Tim. The to kind of put them both on an equal playing field. If Matt touched upon a good point there, that a lot of people will assume that the way to invest in real estate, or I think it was Tim who said, I'm just going to hold on to real estate for the long term. I don't think either asset class is a good, I don't think holding for the long term with doing nothing with it is a good strategy for either real estate or the financial markets. But if you're going to be more active, like if you put trading, the financial markets, where you can trade and you can short stocks and you can buy puts and you can do bear call spreads, etc., that's more active, then financial markets is great. But also, if you have that similar knowledge on the real estate side, where you're not just holding for the long term, but you're actually, say, purchasing foreclosure properties or pre-foreclosures and then getting a huge discount and then adding a little bit of value and then reselling it, you're in and out. That's kind of like trading in the real estate market as well. It's more of an active strategy. So money can still be made on that. So bringing to the the thought about hustle, I don't think any strategy, and this is consistent with my book too, where I don't think any strategy where you just put your money somewhere and then hold for the long term and expect to be wealthy one day is ever good, no matter if the market's up, down, or sideways.
Hmm. Yeah, I agree. And I do want to get into this book as well at some point here, Maddie. And I think it's a good time for us to transition right into that because really what you're talking about is what you go after in the book, is that you can't just rely on old thinking and you try to break down some of the old, poor ways of thinking about passively just leaving your money through home equity or building, a better budget for your life, and that's going to somehow get you rich or whatever it is. First thing I want to do though is just kind of ask you in general about writing the book because and by the way, we're here live, guys. Anybody out there have a goal to write a book at some point in your life? Does anybody share that goal? Emily or Adi? Yeah, I think a lot of people do. Roel, talk to us about how you even wrote the book. What was the process and how did you decide you wanted to do it and all that kind of stuff.
Well, I've always had the idea of wanting to do a book, and the where I actually decided to do it, to write it seriously, was when I was in a 3 month vacation with my family in the Philippines from January 6th, I think, till March 31st, 2015. So just a little over 2 years ago. And I think Matt would remember this, that I was so excited that building up to that. And I thought I had hit the big 40 years old, the big 40 that year or just prior, and I thought, what am I going to do next? What's the next challenge? What's really cool is when you have a lot of free time by investing in yourself, then you kind of just go from project to project, which is really cool. It's like, what am I going to do next? And so I thought, you know what? I've quit my job in financial services, and I've got some pretty good time freedom. And I thought, you know what? I've always wanted to write this book. So I started writing it in earnest, and I just followed the exact same formula as I did how I learned how to invest in real estate and how I learned how to invest in trading the financial markets. Is I went out and I looked for someone to teach me, like a trainer, mentor, etc. So and I followed that person's course. It was a Raymond Aaron up in Canada, and that helped me get most of the book done. And in terms of actually writing it, there's not much of a secret other than just sit down and write
Yeah.
and try to rewrite, and you try to do a skeletal plan or a structure, but there's really no shortcut, at least none that I want to take, because you can take ghostwriters, et cetera, but I really wanted the first one to be really my
Sure.
words. But yeah, I basically followed the same process that helped me get to that point. Was I said, hey, I'm going to get my ego out of the way and just say, someone else has done it before me, I'm going to learn from them.
And I'm very impressed by it, frankly, just because I'm impressed by people getting things done. I know that as a writer, you have to, and there's a great quote by Jack London, who wrote all those Call of the Wild type books, and very, very famous author, that you have to approach creativity with a club, Roel. You can't wait for it to come to you. You have to go after it. If you're going to be a writer, you have
Yeah.
to sit down and write. You have to do it on schedule. You have to do it on pace. I've studied a lot of, great people who create content, whether it's video, audio, writing, you name it. And they all say the same thing. They just sit down and do it. And I think that's an important lesson for all of us to learn. I do think that it's pretty incredible that you got it across the finish line, though, because I've known many people who start with big ideas but don't. Did you ever have a moment in the process where you were like, oh man, I don't know if this is going to happen, or did you just kind of power through?
Several times. It was very close to being done. I remember chatting with you about it and with Matt. It was actually called previously. It was called The Wealth Deception, and 7 money myths busted on your way to wealth. And so it was about 95% done. And actually, that's the copy that I gave to Matt at first. But then before I published it, it was about 95% done. That's when I thought, well, how can I parlay this into something else afterwards? So that's when I invested in another program on how do I use a book to be able to turn it into professional speaking, into online courses, into other stuff. Because the reality of becoming an author, a published author, whether self-published or in the traditional way, very, very few people make money off of just selling books.
Hmm.
Like, you might make $2, $3 per copy sold. It's what you can use that book for
Sure.
afterwards.
I mean,
So anyway, any of us who are on the podcast who want to write a book, don't think that you're going to become a multimillionaire off of selling
yeah,
books.
I don't think that's usually the plan, right? I don't really even know how to monetize the writing side of it. I know that my wife just finished a book writing, and she's trying to figure out a way to get it to the next stages. But you look at even Robert Kiyosaki, the most read financial author of all time. Rich Dad Poor Dad, one of my favorite parts of that story, it was written so that he could better market his cash flow game. Generally,
Yeah.
book writing and that kind of thing is to continue to push message out there and to impact people, or maybe it's a passion project and whatnot, but usually it's not going to get you, filthy rich. So, I mean, there's a reason why we're doing them besides that. And I think one of the major reasons, and I've talked to you, Roel, and I want to bring Matt in on this, is, Roel, you have a deep passion on really trying to help people and teach people. And the 7 myths that you go after, I mean, these are problems that people have in mindset. The time is money myth, savings myth, budgeting myth, debt myth, retirement myth. These things that you've seen from being a financial planner that you knew and and Matt and I see it as well, that people can suffer from these mindset problems. Matt, first off, you have ambitions to write a book one day?
Oh yeah. I've written a lot in my life. A lot of different manuals, different coaching manuals, for legacy, rich dad, whatnot. You've written a lot of those with me, Tim. We're working on a book right now with Bobby Shannon on personal gold, the personal gold system. So we're in the process of writing that book right now, and we're looking at. We'll probably end up you and I co-authoring one on just investing in general.
Hmm.
It's just a process. I mean, when you want to really kind of write a book, like Roel said, it takes a lot of planning, it takes a lot of time, and there's things that you know we're doing right now that are taking up some of that time. Some of the other things, but we'll get there. I do want to ask Roel a question. Roel,
Hmm.
I've known you for a very long time, and I knew when you were writing this book. And what was the hardest part of writing this book for you?
It was getting it down to a bite-sized chunk of main points, like getting it down to seven, or I was trying to get it even down to five, but there was a lot of different things that I wanted to say, and just trying to be as concise as possible, because I didn't want it to be a big, a tome that was all fluff. I wanted it to be a very quick read, and something that if someone was so inclined could actually read it in one weekend.
Hmm.
So getting it concise was really the toughest part.
Yeah, it's getting it concise to the point where you teach whatever the principle you're trying to teach in a very systematic way, right? Making sure your words are efficient, right? That can be hard sometimes. There's no doubt about that. Why? What was it about those seven myths, right? Because there's so many different things we are told that that we're told from either our parents or people we grow up with or even financial advisors. You were an advisor up in Canada for years. What was it about those seven myths that really stood out to where it's you left it right at that seven?
It was really what did I feel were the most damaging myths that I was perpetuating as a certified financial planner
Hmm.
for my 8-year career, and just things like on the more conceptual side, like the time is money. Like most people just all they know how to make money, how to bring money into their lives is to go somewhere and trade an hour for a certain amount of dollars, whether it's minimum wage or whether it's 100, 200, $300 per hour. Or if you're like a professional athlete who earns millions of dollars per hour played, right? It's still hours for dollars. And as soon as you can't trade that time, then you no longer have money coming into your life. There was
Yeah.
just those basics that have just fascinated me. That's like, wait, there's other people who don't have to trade their time for money, right? So it was the
Well,
main things that I thought were really damaging that I wanted to attack.
I love that time is money one, and the reason another good friend of ours, Sam Musa, he likes to get up there on stage and he gets all amped up, right? We've all seen Sam present, and he says, "Hey, everybody, finish this statement. Time is," and everybody says money, right? And like literally everybody. There might be 50 people in the room, there might be 70, there might be 20. They all say time is, and then they say money, and Sam, no, 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 no. Time is everything, right? Time is everything. And I love when he says that because it's true. We are taught that we have to, basically exchange time for money, and that's why we think time is money. And that's a mistake. It's time, our time value is so much more valuable than our monetary value, and we have to realize that. And I also think that's what Robert talks about when he talks about becoming an entrepreneur in terms of instead of donating your time to corporate America to make Apple another $1 billion and you get paid $20,000, why don't you develop and build something on your own? Time is everything. I also love this one, Roel, saving in savings. This is, and you've heard me speak on this a lot, Roel, and I think
Hmm.
everybody knows where I believe in saving money, right? So, but this is saving in savings, meaning you're saving in money. Why is that such a failed dogma? Why doesn't that work?
Well, the short answer is because currency is a depreciating vehicle, and it can be printed ad nauseum out of thin air by any central bank. But it goes, as you know, the rabbit hole goes much deeper than that. One thing I like to often say is, for people who are just getting exposed to this, is when they hear on the news that the country or the government is shooting for, say, a 2% inflation rate, and that's what they want to have happen. I said, but if you think on the flip side to that, what does inflation mean to the person who's trying to save their money in a savings account or in a checking account? That
Yeah.
means your purchasing power has just gone down by 2%.
Yeah.
So if you think of it another way, is the government is actually, uh, their intention is to, one way to look at it is to decrease everyone's dollar purchasing power by 2% a year, and they think that's healthy.
Hmm.
So, and Robert also says, Robert Kiyosaki says, savers are losers, and I think that's a layer of what he was meaning by that statement.
Well, and to make sure we're clear on what Robert's talking about there, he's not talking about the person. He's talking about the fact that we lose buying power when we save. I think all of us believe in saving.
I know Robert
Okay,
enough to
we
where
just
he might be talking about the person a little bit there.
he might be talking. It depends on who the person is. It does it does depend on who's asking the question. Tough as hell he is, but no, it's honestly, it's about saving in assets, right? Saving
Hmm.
in assets. That's what it's about. We all believe in saving money. We believe in saving money in assets, assets such as real estate, assets such as stocks, assets such as business, assets such as commodities. It's not saving money in money. Never save money in money. Never. I tell people, I say, hey guys, listen, I'm willing to bet that you have more money than I have. And people look at me like, no, no, no way. I'm like, yeah, I'm willing to bet that you have more money than I do. And they're like, no, because they always just think in money. I'm like, no, 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 no. I don't have money. I don't. I don't. I have $25 in my savings account. I think I have $80 in cash in my money clip for tips and tricks. No, we have money in assets. That's where we save money. So money, all money is what you can allocate it in. That's all it is.
Mhm.
Obviously, we need money to pay bills, right? No, use a credit card, pay off the credit card every single month, get your credit up. There's different ways to do it. Another one is the budget myth. The budget myth, right? We all,
Hmm.
and let me just ask the class here. How many of you believe you should budget more appropriately? Because I certainly do. Yeah, I certainly do as well. So
Well, to
what do
be
you
fair, let
mean
me answer
here,
that one
Roel?
first, Matt, before you go past. I,
Yeah.
I think my wife should set us on a budget more appropriate for us since she's the one who handles it.
She is. She is.
She's
I wish my wife would budget more. You wish your wife would budget more for you. No, I get that. But Roel, what are you referencing here when you talk about the budget myth?
Well, the myth part of it being that, uh, even just the act of writing down your income, expenses, and theoretically saying, well, if I just kind of shave off this and this and that, all the numbers fit nicely and I'll have enough money to save. There's the mistake number one, right? It's more like the act of budgeting. It's a good exercise for people to do. Very few people do it anyways. But the key from my experience as a financial planner going back, and even personally, is that any budget is not worth the paper or even the Excel spreadsheet that it's written on if you don't have an overarching reason as to why you want to budget.
Yeah.
So the spoiler alert on that one is the having a reason why you need to budget. So when you go about your day and instead of going to Starbucks and paying $5 for a coffee, and if that's your little treat, and you say, well, I can just go to Dunkin' Donuts and spend $1.50 instead, and I can budget that way. That's approaching it as sacrifice. You're feeling like you're doing without. But if you've got this bigger dream as to, you know what, I want to be able to quit my job. I want to be able to travel the world. I want to be able to just be able to attend my kids' recital whenever I want and not be constrained by trading my hours for dollars. If there's a bigger overarching inspiration, then when you choose to go to Dunkin' Donuts, it's not a sacrifice. It's
Yeah.
because it's no big deal.
No, love it. What about the debt myth, Roel?
That one is there's a few layers to that as well. For some people who don't know that there's that debt, I guess at one level, there's a lot of people that think that all debt is bad. The next level up would be that there is good and bad debt, and then the next level up for that is what I tackle in there in that chapter is how to define what's good debt, what's bad debt. Because as a financial advisor, people used to say, or I used to say, that good debt is attached to an appreciating asset. And that was one level where I thought I was educating people, but then when I got exposed to the philosophies that I learned from you guys and as well through Legacy, was that the debt needs to be generating monthly cash flow. So the true definition of good debt is figuring out who's paying back that debt. Is it you,
Yeah.
or is it your tenants, or is it your trading system? So it's figuring out who's paying that money back on your behalf, and does it keep extra in your pocket at the end of the
You know
month?
what's amazing to me about this, Matt? Just listening and thinking about this problem. I find it incredible that many of these myths and many of these things that people have built into their mindset come from their parents or generations of people that weren't necessarily the wealthy. I think of our own family, and I think that the debt myth was a huge part of what was planted into our dad's head, right? You don't go into debt, you don't
Yeah.
go into bad debts. And that came from his mom, who basically lived in poverty most of her life, just above
Well,
poverty, I
she
would
was
say.
Great Depression.
Yeah,
She was a
you
Great
know,
Depression woman, coal mining family. Yeah, I mean they did live in poverty, but and so we were passed that on. Don't use debt, don't use debt, don't use that. But our father taught us amazing things, no doubt about that. But the reality is this, guys, you can use debt to buy things, and you can use money to buy things. That's the reality. Can we all agree with that? That you can use debt to buy things and you can use money to buy things, which means they are both used for purchasing power. Okay. So here, if you refuse to use debt to invest in, what you're really saying is that for every you only want to use $1 for every $30 that exist. That's what you're really saying. So what I would recommend is use debt, because all it is money. All money is debt. Debt is money. Money is debt. So if they're fairly similar, use debt to purchase assets. Use those
Hmm.
assets to cash flow. Use that cash flow to buy the things or to pay the things or whatever it is. There's a more effective and a more efficient way to do it. And it comes back to this woman I was talking to this previous weekend. She says, Matt, I got a lot of debt. I said, well, you might need to go into more debt to get out of debt. And she looks at me, she goes, what do you mean? I'm like, well, think about it. If you have to use debt to invest in, and you then use those investments to cash flow, you create velocity of money.
mm.
And if you create velocity of money, then you can get out of debt, right? And she's just like looking at me like this, who are you? I'm like, I'm just a dude from Huntington, Utah. I'm just a dude. That's all I am. I'm just a guy, right? But it's time to evolve, right? We have to embrace debt, but only to buy things to buy assets,
Now,
Retirement.
if we
I
can
love this.
contrast,
Yeah, go
if a
ahead.
quick little contrast on that one is oftentimes when I'm also speaking now in like the free previews, uh, is I put it to the general public in the sense of think about how willing each and every one of us are and this is the group of people who are there who have presumably not taken any education yet. It's so quick for the vast majority of the middle class to borrow money to acquire something that's going to require taking even more money out of our pockets, like
Yeah.
your personal residence, your car, your big screen TV, your cell phone, the latest smartphone that comes out. It doesn't just go it doesn't just mean that we have to pay back that debt, but then we also have to pay property tax, insurance, maintenance, gas, mileage, repairs, internet bills, cell phone bills. So it requires more money out of our pocket. But then very few of us will actually inherently think, okay, I'm going to borrow money and
Yeah.
invest in an asset like a trading system or like a rental property that's going to actually put money back into our pockets.
Yeah, no doubt about that. No doubt about that. What about retirement? Everybody wants to retire, Roel. Everybody does. I'm willing to bet that everybody here wants to retire. Would you guys agree
Yeah.
with that? Everybody wants to retire, right? We all want that. We all have that desire. So, what are you talking about with the retirement myth?
The big myth about retirement is that it's not what popular culture portrays it to be, where you have to wait till you're age 60, 65, till you have a head full of gray hair, and then you can sail off into the sunset, and you can just afford anything and everything that you want. The reality is the way it's perpetuated in by financial services, especially, is that you hoard your money, you save until you have a nest egg, and
Hmm.
then you can spend it freely. But the 60, 65-year-olds that I know have gotten there and have quit their job, they're so scared to spend their money. Like they don't want to deplete it because they know
Well,
that they can't
they
go
can't.
back to work to replenish it.
It's Roy, it's so amazing because our entire retirement system is so out of touch with reality. Okay,
Yeah.
with any semblance of reality. Here's the retirement myth. Okay, you're going to go to school and you're going to go to school and you're going to go to school 5, 6, 7, 8, 9, 10 years, right? You're going to go into debt to go to school, right? You're then going to get your first job around 25 years old on average. You're then going to work for corporate America or government or something like those lines for the next 40 years of your life to hopefully save enough money by the time, whether that's in savings or whether that's in a 401k, whatever it is, to retire at 65 years old, and you're going to make enough money that before you won't go broke before you die. And but the reality is people don't make enough money, they don't save enough money, and they don't offset inflation or the devaluation of the dollar enough to actually have enough money to actually participate in it like that. And so you meet these individuals like, no, I can't spend money because if I do, I don't have enough money. And it's like, well, that's because you bought hook, line, and sinker into this lie of retirement. See, I think it's a bold-faced lie because I don't believe in retirement. I retired at 32 years old. That's when I retired. But that doesn't mean I don't work. I just retired from corporate America. I won't work for corporate America. I won't work for government. I won't work for anybody because nobody's more efficient than I am and nobody's more efficient than you guys. Because when you're an entrepreneur, when you're a business individual, your money can live can even cash flow after you're dead, which is the ultimate retirement. So retirement for me is when you stop working for other people and you start building businesses and you start cash flowing off investments and you don't have to work for anybody else. See, retirement for me and financial freedom for me is this: if you have the freedom of time, you're retired. Okay, that's what I think it is. If you have the freedom of choice, which means you can come and go if you choose, then you can do that, right? I'm sure there's a lot of people listening that will be listening to the replay of this podcast, but they had to go to a job and they couldn't be here live. Well, to those people, I'd say set that as your goal. That on a random Monday afternoon, you can hop into the podcast with the Justice Brothers and we can just have some fun, right? We can just have some fun because that's what life is about. Net worth, home equity kind of go in line with one another there, Roel. What's the myth on net worth?
Well, it ties into that the retirement as well. That's why those I put in that order. It's again the myth that the government, that financial services perpetuates that you need X amount. And I know we've all used this in our trainings and presentations, is that there's many studies that say you need X amount somewhere around in the range of 1.3, 1.5 million dollars on your retirement date to be able to then retire comfortably, quote unquote.
Yeah.
So again, it's you can't hoard your way to wealth. It's a limited supply, and if you don't know how to acquire an asset or intellectual property or a thing that will continue to put money in your pockets in perpetuity every month, then you're always in this scarcity mentality. So people say that, well, I want to become a millionaire. We have a lot of millionaires, especially in Toronto, who are just equity property millionaires. And I try to tell them here that we've learned nothing from our friends down in the U.S., where I've met in our ballrooms, and some of them probably with you guys too, where people come in and they say, I was one of those people who had over $1 million in property equity in a few different things and then lost it all, and now I'm looking for a new answer because
Yeah.
I don't have long term to build it again. So it's a
Well,
myth to think that if you have a balance sheet $1 million that you're financially free. It's just not so.
well, think about it though, guys. Let's say you have 500, 600, 700, 800, $1 million, right? Let's say you've done that. Those people have typically done some really good things in their life, right? From a career perspective, from an education perspective, whatever the case is. But how quickly can that go? What would have to happen for $1 million just to go up in smoke like that? Personal tragedy, death in the family, cancer, um, somebody gets sued, right? It happens. It happens. I had somebody in my ballroom this weekend. Okay, it was one of the coolest guys, just coolest guys. He was a New York police officer. He was around on 9/11. His brother actually died in the towers. Right before that happened, his wife passed away from cancer. He had done some really great things in his life, and it's just an amazing, amazing attitude, wonderful, wonderful mindset. And he said, I'd done everything, and it all left. It was all gone. It was just gone. It was just, I'm 60 years old, and I'm starting over. And it's the what ifs of the world, because that wealth, it's not about accumulating wealth. It's about accumulating cash flow. It's about your theta score, guys.
Mm.
That's what it's about. So when somebody tells
Jake,
me, hey, I got X amount of money, I said, oh, really? What's your theta? What's your theta? Because that's what I care about. Do you have a 1200 theta account? Well, if you have a 1200 theta account, then you never have to worry about money again. But if you have $1 million, you might have to worry about money again. And there is a vast, vast difference in those. So whenever we think about wealth, we always think about theta. That's what we think about. Home equity, last one, the last 7 myth. Home equity. Talk to us about that, Roel.
well, yeah, that ties in as well because it's a nice way to kind of round up our conversation too, because we were talking about real estate a little while ago, is that real estate prices have almost recovered to pre-crash
Mm-hmm.
prices around US especially, and beyond in Canada. It's quite high, and again, that equity, it's theoretical wealth in a way that I sometimes put it, because it's not, especially if it's in a personal residence, it's not generating any monthly cash flow or cash inflows for the individual, and quite the opposite. It's still generating cash outflows. So a lot of people are sitting on their personal residence, and they're thinking, well, I've got two, three, four, $500,000 worth of equity. I'm pretty good, and I'm going to retire in about 10 years. So I'm right on track. But then they've all forgotten what happened in 2007, 8, and
Or the
9,
market
especially in the
collapses.
US. Yeah, and
Yeah.
it just poof, gone. And
Well, and
what's worse is even people are trying to pay down their mortgages even faster, and then when the market turns just a little bit, all that extra money they were dumping into paying off their mortgages is just gone in thin air.
Roel, you talked about how it recovered even more so in Canada. You want to know why? Because after 2008, we couldn't, in the US, we couldn't do the things, there were regulations, and we couldn't do the things that led to the subprime market crash. So you know what we did, Roel? We're
What's
good
that?
Americans. We exported subprime to you guys.
Hmm.
Is what we did. That's and I'm
Thanks.
not I'm not kidding. We did. We exported subprime to Canada. We exported subprime to China and other nations around the world. That's what we did. Okay, because we had certain regulations here in the U.S. We couldn't do certain loans here in the U.S. And so we were good neighbors. And like a good neighbor, you know, not is it State Farm? Not State Farm.
Yeah.
Like a good neighbor, America is here, right? We'll provide you all the wealth needed to crash your markets. That's what we're going to do. Loved, Royal. Honestly, though, loved the book. I thought it was an amazing. I thought it was an amazing read. I think it hit on every point you wanted to go, and I still feel extremely honored that I was one of the first people that you trusted to read it. And I thank you for that, and I thank you for coming on the pod to talk about that. But we got a couple more segments we're going to quickly go through, ladies and gentlemen. Did you guys enjoy the book? Did everybody enjoy the book? I know Cam, Tim, myself, we
Loved
all
it.
enjoyed it. Awesome. Now, in terms of our two next things, we got a coach's mailbag and we have a would you rather. But we've already kind of done the would you rather. Tim, do you have any more would you rather's?
I've got a, well, first of all, this is a game I play with my kids. And by the way, me and my kids made up a new game, Matt, that I may bring to the podcast at some point. We love car games. So like when we travel and my girls are in the back seat, we like to play games. So imagine like I Spy and whatnot. Would you rather just happens to be one that we've played for years and years and years. So Roel, I have a would you rather. All right.
Mm.
Would you rather, okay, trade the financial markets full time for a living, or spend the next 5 years in a retreat in Southeast Asia, meditating and finding yourself?
Oh, 5 years?
Yeah,
If that's the key for me, I would rather trade. I don't know if I could do the meditation thing for 5 years
I don't
straight.
know if you know this about Roel,
Gotcha.
Matt. He's gone to some of these silent retreats and he does them for like a week or whatnot. He's very Zen, very
Yeah, a
Eastern
week, a
minds.
week, sure.
A week, all right. Gotcha. So,
I'm not going for 5 years to zen out anywhere.
right.
Yeah.
That's a pretty big commitment.
No.
Yeah.
Yeah, I might not go out for 5 days to get my zen on. That's
All
you.
right. So
You and Phil Jackson. You go zen out all you want.
5 years a long-term thing. Obviously, you're talking Buddhist monk territory at that point. I don't think I would even commit to that. But I do think it's important that we do connect with all of the different things we're doing. Including that connection to the world, connection to the universe. Meditation's a
Yeah.
very, very powerful thing. So now we understand the basics of the game. You just pose one or the other, you answer one or the other, and then we go. So, Roel, I want you to think of one that you might come up with. I got a trading one, Matt. I'm going to throw this out to the group. We were talking Apple earlier, but I want to look at a couple of different, like, mid-cap companies. Roel, would you rather invest in Tesla, for the long term, based on the expectation of Elon Musk and what they're doing, or Chipotle, Mexican Grill? Which one of those would you rather take?
That's the
Oh,
dumbest would you rather of all time.
that's
That's
a little easy. That's kind of an easy one for
that's
me. I
awful.
would go with Tesla all the way.
That's, would you rather?
And I know Matt would agree with me on that
I
too.
just wanted to hear Matt react.
You're really stretching there, buddy. You're really struggling with finding a decent would you rather. If it's let me invest in a terrible Mexican burrito company, overvalued with a 600 PE ratio, or let me invest in probably the next Steve Jobs of the world.
You,
Yeah, I think I'll just take a Tesla on that
You know
one.
what's
No,
interesting
no
about
doubt.
both companies, Matt? Their PE ratios are in the stratosphere, and we're talking about a tech
Well,
bubble.
Tesla's even negative.
Yeah.
Hey, listen, I would rather invest in a negative P ratio than a 600 P ratio.
Well, people will buy burritos for long term. They may not buy $130,000 cars. And if some of these bets don't come through, I don't think it's as obvious as we're saying here. But I definitely would say Tesla. Okay.
I think it literally is the most obvious question in the history of mankind. Would you rather eat a pie or get punched in the face by Mike Tyson when he was Iron Mike? That is how ridiculous that question was.
I,
Let's move on. We got last segment here. Promise you guys it's not going to take too much longer. We got coach's mailbag. Coach's mailbag. So we got a couple questions out there. We're going to read. And for those of you guys that are live, we want to answer your questions. So if you guys, yes, BTC baby, all the way Bitcoin, going to hit my price target S1, 1,500 to 2,000 this year, right? So you guys can ask us anything, right? Anything, any question you've ever wanted to ask, we will answer in the most honest way possible, right? So if you have any question out there, go ahead and type them into chat. Tim, I have a couple from some of our team members over there in the clubhouse. Tim, I got one right here. Listening to the latest podcast on Forex trading, I'm wondering if there's a video example or possibly a blog on the Bank Open Trade. I'll answer that one. If you go to tackletrading.com, okay, so if you go to tackletrading.com and you type in a couple different things into the search, let's go to bed. I think I did a couple videos that I listed as the go to bed trade. There it is right there. So just go to tackletrain.com, type in go to bed, and you can get a couple different lists. There's also some Forex Trading 101 videos, and we're also working on the Forex Trading 101 trading system as well. If you also type in Bank Open, there might be a couple videos on Bank Open as well. Yep, there you go. Train Just 214. Then we have a couple bank ones here. But go to bed. Type in go to bed into the search function, and you'll be able to get that one. Tim, next question I have for you here. And Roel, that'd be good on you too. So Tim and Roel, how much is the tax for short and long-term investments?
Well, you have short-term cap gains tax, and then you have long-term cap gains tax, and it just depends on how you're clearing it. Also, contracts are taxed differently, Matt. Some of it's going
Yes.
to be dependent on how you've set your structures up, and what I would tell you is make sure that you actually just pay a tax accountant. That's what I do, and they file it for me. Essentially, short-term cap gains tax, if you are clearing it that way and you're not set as like an active trader status where you can do mark-to-market deductions, it's going to be higher, right? It's going to be higher. I don't know what it's up
You
at
can
there in
think
Canada, though.
you can think of short-term trading typically is taxed at earned income levels
Yeah,
after tax deductions to a business. And long-term stock investments are typically taxed at capital gains tax, 10 to 15%.
yeah.
But it also depends on your the strategies you're doing. Like you said, contracts versus stocks, but also currencies versus commodities. Currency trading is, I think, taxed less than 10%. Bitcoin is not taxed unless you announce how much money you've made. And
Yeah.
that's totally up to you. It's
Nice.
the honor code. It's the honor code. So if you want to be honorable, tell them how much money you made in Bitcoin. All right, we got a couple more others here. I'm gonna read them. We got let's see. Sherry, is there a video or a blog on how to use Fibonacci? Tim says yes. It's very simple. Right click it to delete it from your charts. But there are a couple. If you'll just go ahead and type in Fibonacci at Tackle Train, you should have one out there. I know I've done a couple videos on them. Jing Lee, when will TackleTrading.com be mobile compatible? Jing, it is being worked on right now. We're in the development stage of the new website, and we're in phase 2, and we're expecting it to be released in sometime late summer. And at that point, mobile compatibility is definitely on the list to make sure everything we do
I got one,
is
Matt.
mobile compatible.
I love this one.
Yeah.
This one's from Tommy Hammonds, one of our long-term team members over there in the community. And this one will connect with you, Matt. And I believe you already answered this one in the clubhouse. But he says, I trade at home with 4-year-old twins. Does anybody trade with
Yeah.
kids, and what do you do to occupy them? With love from Texas. And Roel, let's get everybody's answer on this because we all have kids, young kids. Matt, you first.
Hmm.
Um, you know, I some people understand kind of why I retired from Legacy, but when I retired from Legacy at 32, I was at home for about 4 straight years, and in that time period, I had my youngest daughter, Katira Justice. She was about a year old, and I would literally just set her on my lap, and I would be trading with her, and I would point out different patterns, and I would explain to her, and then I got her an iPad eventually, and she would watch some videos. Sometimes when she got to the point where she was crawling and walking around, and she would just literally sit underneath my desk watching her iPad while I was trading. And I used to even teach Master Trader, and a lot of times she would come in and sit next to me while I was teaching Master Trader, or she would just sit down, put the headset on, sit down under the desk again, and kind of that was like her sanctuary under the desk with her iPad, headphones on, listening to me trade or whatnot. But what I would suggest is the very reason why people want to learn how to trade is typically a reason why people want to have their kids learn how to invest and trade as well. And it's amazing how intelligent children are. We all get so amazed, like, oh my God, they're so smart, they're so this, and they are. They're sponges. They soak up everything. So what I would suggest is as you're learning, as you're going through that, make them a part of it. It's an amazing thing to share with your children, with the people you care about the most. And sometimes it can be a difficult thing sometimes. and sit them down and tell them why you're doing this. They explain to them why you're going through this, and see if they want to be a part of it. It's an amazing thing.
Yeah, for myself, I've had both my I have a 3-year-old and a just over 1-year-old now. I've had them in my office with me as I've been participating in some of the live classes and some of the coaches shows as well. And for those reasons too, I also have a very supportive spouse who helps with taking care of my kids when I do need total focus. But that's also why I've leaned more towards cash flow and theta strategies, which it doesn't really take a whole lot of intense time for a long period of time. Like I'll do naked puts, covered calls, iron condors. That's basically it. And so it's a matter more about my personal discipline to tear myself away, because at some point, 30, 40 minutes into it, I'm just staring at charts and it's really not productive.
Hmm. Yeah, I think that's an important point. And Matt, I love the stories, about Kat watching charts and whatnot. I know that she can read a chart, and my kids, they've seen what Dad does, but I can't get them interested, very often. Madeline, she sits on my lap. She's my youngest, and she probably has seen more charts than any of the other two. Out of my three girls, one of the best things that I've found is to get them interested by, giving them some skin in the game, like buy some shares of a company or whatever, put it in their long-term accounts. Hey, this is what this is, or whatever that may be. You got to try to plant seeds. You can't obviously make your kids do something. But I've seen this, and I know that our team members around the globe here, they've sent me pictures, and I've seen them on social media. Kids can eat up a chart, and
Oh yeah.
especially when it comes to technical analysis. If you have young people that are like video games, or and we see it all over the place. They're natural with technology anyway. You might as well get them in front of a forex chart, right?
Well, they are natural with technology. In fact, they're better with technology than most adults are. And they do get charting. But you know what else they get? And I think this is cool. And I want everybody to try this. This week, okay, here's a homework assignment this week for everybody. If you have children, I want you to sit down with them, and I just want you to talk to them for 30 minutes about what they like. Just what they like, right? So go like with my son, I'd go up to him, sit him down, and say, "Hey, Tim, what do you like?" Okay. Well, Jen, that's a tough one, Jing Lee. That's awesome, though. Congratulations, by the way. But what do you like, right? My son likes to game. Okay, and then you would say, okay, well, let's go look at some companies that game, and I'm willing to bet they already know them. Like my son, he already knows Activision. He already knows, GameStop. He already knows these things, and then pull up the chart and just buy one share. Just buy one share, and make them own that, right? My daughter, what do you like? Oh, she likes makeup, right? Well, ULTA. My 7-year-old, what do you like? I like money. That's what my 7-year-old likes. She's a stone cold killer. She is a financial market assassin, right? That's who Kateria is. She's a financial market assassin. She's a killer. And so I'll say, what do you like? I like money, right? And I'll be like, all right, well, we got to go to currency there, honey. So pull up the US dollar euro chart, right? Just it's amazing what they will be if you just include them in some of these financial discussions. Because if we can all do that, you know what we're all going to act as? We're going to act as their rich dad and not their poor dad. And I think that's a beautiful thing.
I think it's wonderful. I think it's wonderful. Guys, this has been our live podcast. I do want to start wrapping this one up. Any final questions here in the chat? We'll take a look maybe at one more here.
We got one from Esteban.
Yeah.
We got one from Esteban. Thanks, Matt. Saw your video comparing real estate and the stock market, and it seems easy to learn to have at least 1%. Yes, I think everybody should target more than that, Esteban. The Tackle 25 is a great cash flow list. I haven't done the averages, but I think the average cash flow on that list is over 2.5%, including growth and drawdown. I think you could safe to say to target 2 to 2.5% on something like that. Obviously, there's going to be months of drawdown, and sometimes there's going to be months of growth. But if we're looking to cash flow offset risk, absolutely no doubt about that. Tim, send us out.
Trading Justice number 215. Big thank you out there to Roel and all of our team members. Guys, without you, we wouldn't have a podcast, and we love doing it. It is a passion of ours. A couple of big announcements. Number one, go to our website, tradingjustice.com, and bookmark it. We actually just got a fancy, shiny new website kind of implemented here today. So let's see if we can go crash it by having everybody go there at the same time. Number two is we're going to put
Absolutely.
out we're going to start putting out a newsletter, and sign up for our newsletter if you want to get that. That's going to be separate from everything else we do. Matt and I will write that. That will be once monthly, and I think our target will be the 1st of June. So June will be the first month we're going to get that out there. We're going to get some things going over here on Trading Justice on its own as well. The other thing is, Matt, our next book club. Now, Matt, we decided on June the 5th. Cam, write these numbers down. June the 5th is the first week of June, guys. So we're going to give you 1 month. I think 1 month we can definitely turn it around. And we're going to do 2 p.m. Eastern. We'll do them during the day like we have in the past. And just kind of open up the webinar room. We'll record it, and then we'll go from there. The Way of the Turtle. Matt, describe. You picked this book. We were looking at them together.
I did.
I instantly said, great pick. Why'd you pick this one?
The Turtle Traders is such a. They're two things to me. They're number one of the most inspirational trading teams of all time. Obviously, at Tackle, we all believe in teams, and whatnot. But Richard Dennis was the guy who really started the Turtle Traders. This back in the early 1980s, and he basically set out to prove that people could learn how to trade. And he not only did that, he did something more amazing than that. He not only proved that people can learn how to trade, but he also told all of us that we can do this as well. It's there's a lot of different books. Curtis Faith is the author of that. He's one of the original turtles from the original class of 1983. The group was put together in 82, released in 83, and just had immense success. And they had one thing basically they shared in the success of each other, in the sense that they trade the same system, the same strategies, the same techniques, and the way of the turtle, right? It was all about Richard Dennis said we're going to build traders the same way they do turtles, right? They're going to follow each other. And Richard Dennis later on said in his life, he said, teaching people how to trade was even easier than I thought it was going to be, and I'm the only one that thought it was even doable. We trade the same system, we trade the same techniques, and that message I read about Richard Dennis a few times while I was learning how to be a trader, and it was probably inspired me more than any other book in terms of what I've done in building systems. We believe in systems. We built the original one there at Rich Dad Legacy back in 2008 to 2010. And the systems we're designing now for Tackle is just absolutely some of the best ones out there, all based on probabilities and cash flows and ROIs and so on and so forth. And that journey in learning how to build trading systems and that inspiration really was kind of started by Richard Dennis and my reading of Richard Dennis. So I thought it was time to read Curtis Faith's book, The Way of the Turtle, from the original class of 1983, and I think it's going to be a wonderful, wonderful podcast. I think it's going to be a wonderful read. And in that pod, Tim, we're not only going to discuss the mindset behind the turtle traders, but we're also going to get into their systems and why they focused what they did. I still believe today that Eddie Murphy's movie Trading Places was inspired by Richard Dennis and the Turtle Traders, so we might have a little discussion on that movie as well. Great movie from the 1980s. So guys, everybody pick up The Way of the Turtle. You can get it for like $17 on Amazon. I also believe there's audio for like $3 or $4. But definitely check it out. We'll have a wonderful, wonderful podcast, and we're gonna make sure we let everybody know when we're gonna do it a little bit more than a couple hours in ahead of the podcast. So we'll get all that information. We'll do this right. So looking forward to having that discussion, and we'll see you guys next time. You've been listening to the Trading Justice Podcast, Book of the Month Club Edition, presented by Tackle Trading. Get in the game, one trade at a time, changing lives. Thank you, everybody, for joining live. Thank you, everybody, for listening. Thank you for being the best part of Tackle Trading. Thank you for being the best part of Trading Justice. We'll see you next week.